whichever person that is taking you will have summarized the whole chapter for you and will have touched all aspects that is expected of him to touch, giving you an advantage over those ones that they just need to sit down and start reading from beginning to the end. You can see the what's it called? This is the example they give. They are just trying to explain one after the other. They are just trying to explain one after the other. This is gearing ratio. This is the formula for gearing ratio, debt to equity ratio. You can just go and check from page 806 to 806 to 827 in your FR study pack, chapter 25, 806 to 827. And there are some questions as well that you can actually solve. They are very simple. Like this one now is asking you to calculate gearing ratio. And based on what we discussed last class, what is the formula for gearing ratio? What is the formula for debt to equity ratio? Debt to equity. What's the formula? Are we still together?
Yes, we are together.
Yeah, can you just revisit the formula I gave to us the other time and give us the formula for debt of equity ratio, and that of gearing ratio? I just want to show what I want to prove to you is that what we are covering in the class, or what we have covered in the class, is actually more broader than what is even in the test, in the study test. So if you check the formula I gave to you, you will see that we have already covered debt to equity ratio. And I'm actually expecting you. I'm not even going to solve it. I wanted to solve it before. I'm not going to solve it. You can actually go and solve it yourself. Debt to equity ratio is long-term debt all over share capital plus reserve. That is your capital employed. Share capital plus reserve means capital employed. Are you getting it now? And I've actually explained how you can get your capital employed that last class. Then gearing ratio, it is long-term debt all over share capital plus reserve plus long-term debt. So this one is going to be equity plus long-term debt. If you check the formula I gave to you last class, I said long-term debt all over share capital plus, I said long-term debt plus all over long-term debt all over equity plus long-term debt. Your equity is your share capital, your reserve, plus your what? Plus your long-term debt. And what is your long-term debt? Your long-term debt is your non-current liability. Your non-current liability. So please, and you can see, I think I explained this the other time. If the company is low geared, if it is highly geared, you can see now. They also wrote it there. They said a company is said to be highly geared if you read this under highlighted sentence. They said the company is said to be highly geared, or high geared, or highly geared, or highly leveraged when its debt capital exceeds its share capital and reserves. This means that the company is high geared when the gearing ratio is above either 50% or 100%. Are you seeing it now? So this is what we have explained. This one is just a guideline. You cannot be expecting ICAN to be splitting, to just be asking you to calculate one ratio. So they will merge everything together for you, and that was the reason why we brought that particular question last class. And actually has advised us that we should go and attempt 2 questions from different diets. I don't know, maybe all of us, we have actually been able to attempt it. If you have attempted it, thank you for attempting it, though you did not send your response or your solution to me. Yes, I knew of one lady like that reached out to me when something was not clear to her, which I was able to explain. And I believe she will have done with it by now. So please, all these assignments, they are important. Now, if you are FA student, if you are financial accounting student, ratio analysis is found in chapter 18. That is page 508 to 530. 508 to 530. And if you are SBR student, strategic business reporting student, your own ratio analysis is found in chapter, I don't know the chapter now, but it's found in page, chapter 29. Yes, chapter 29. and is found from page 986 to 1033. 986 to 1033. Are we still together?
Yes, we are together.
Yeah, if you look at this one now, let us go to that one 986. Let us go to that 986 so that we can see what is inside the SBR as well. You will see that there is no like huge difference like that. Where they are going to test the SBR for foundation student is the application, your applicability, your ability to apply what you have actually found. That is what they are going to test. Yes, they are going to test that also in skills, but more of it will actually be in SBR. As we are going to solve SBR question today as well, we are going to solve a ratio analysis question from SBR today. So we will see what they are trying to test. 986. 986. We are still coming to all this topic, but let us just take it one after the other. Penny per share, we are still coming there by the grace of God. Hey. All right, this is 29 now, chapter 29 from page 886. You can see Introduction to Financial Analysis, Common Size, Introduction to Ratio Analysis, Return on Capital, Profitability, Asset Turnover Utilization, Working Capital, Efficiency Ratio, Liquidity Ratio, Debt Ratio, Investors Ratio, the limitation. We treated limitation last time. Limitation is also in SBR, is in FR, is also in FA. And then you can revisit that summary note I sent to you last class. You can revisit it. You can see users of their information, users and their information need. Who are the users of financial ratio, financial accounting reporting, or financial reporting? Who are the users? So you can see, as you can see now, we have this. We have horizontal analysis, as I explained the other time. We have time series, we have common size, we have industrial average. So just to cut the long story short, go through all this pack, go through what the content of the pack, what they have written, go through it. It is good for you to just just brush through and then recollect what you have been taught in the class. But don't limit yourself to what is in the pack. Don't limit yourself to what is in the pack. And that is even the reason why I'm bringing past questions, so that you will see what is in the pack and the past question that is being set, in order for you to know how to sit tight and how to sit well. I will be bringing past questions. I will be bringing questions from other textbooks, which I believe is going to help us to actually prepare well for the examination. So, without wasting of our time, let us go to today's question. So today we'll be treating same ratio analysis because we have not exhausted it. We haven't exhausted it. So as a matter of fact, even if we still want to keep on solving questions on ratio analysis. As I told us last class, I said ratio analysis is being repeated almost every diet now, almost every diet. And I sent a copy of compiled past questions to us last week or this week. He sent a link to us. If you have not downloaded it, please go and download it and check. You will see that they've actually adopted the style of repeating that ratio analysis in different form. That means you already know that 20% or 20%, yes, 20% out of the mark, out of the 100%, will always be from ratio analysis. And if you can actually get it right, let us even say you cannot get 2020. If you get 15, then at least you will know how to work your way around the remaining 35 marks. So today we'll be picking our questions from SBR again. SBR, and that will be coming from November 2023, question 2. November 2023, question 2. Can you open it on your phone? Can you open it on your phone?
You mean the topic?
No, this question, this particular past question. Do you have it?
No, it didn't say it does.
Okay, maybe because this SBR question. Don't worry. Should I screenshot and send it to you, or you will just are you seeing my screen like this? So after the class, we can actually work around getting the question across to you.
Please,
Hello, sir.
stand it group.
Someone is speaking.
Hello, sir.
Yes, sir. I'm with you, sir.
Good afternoon, sir.
Good afternoon, sir.
Can you send the soft copy on the group chat?
Yes, we have sent it before. I sent a link. You know, all these parts they are okay.
The
I'm with you,
question.
sir. I'm with you, sir.
I mean the question, the SBR question that you want to treat now. Can you send it on group?
Okay. Let me
so that we
let
download
me
it from that place.
Okay. Let me try to do that.
Okay.
I was thinking before that all of us have the questions, so I did not put the question in a separate form. I was like, all of us we already have the question. We just start the solution and then so that we can save our time. So that's actually the reason. So I'm sorry for that. See how we can work around it. All right. Please let's check the question like that. Are we still together? Are we still together?
Yes, we are together.
All right, thank you. So please let us go through this question together. And as I will be reading it, I'll be explaining little things because this is one of the differences between SBR and FR. And as a matter of fact, not really difference like that. They can decide also to set something like this in FR. They want you to apply they want you to apply information in the question they have set to actually they want you to inculcate those information in your report, in your interpretation. So please let us pay attention to it. Let us pay attention to it. As you can see, this is question 2. Octopus Petroleum PLC is a multinational oil and gas group operating in Nigeria's Delta area of Nigeria. The company has been highly profitable over the years. The group explores and extracts natural resources, old reserves, and has recently become involved in the downstream sector by opening various commercial retail outlets for sale of petrol to motorists. Are we still together? Are we still together?
Yeah.
All right, thank you. In June 2020, the company was involved in an ecological disaster in Ogoni area of Niger Delta as a result of massive oil spillage due to some technical faults, thereby resulting to spilling oil into the surrounding ocean and damaging wildlife and local community. This is a problem, a sustainability problem now. The company, they are achieving their goal while damaging the environment, damaging the future of the environment. So pay attention to this. Assuming we are writing like a case study now, for those of you that will be writing case study, this is an ethical issue. This is an ethical issue. So pay attention to that. Investors are concerned about the future prospects of Octopus Petroleum PLC and whether it represents a safe investment since the company normally operates in lucrative oil and gas sector. Octopus Petroleum Group annual report for the year 2020 and its comparative figure are shown below. So now they give us the consolidated statement of profit or loss. We are still going to that by the grace of God very soon, maybe next month or 2 months' time. We are going to start group account. So please watch out for that. So this is consolidated statement of this is the consolidated statement. Now we all know what group account means now. At least I am very sure all of us will know what group account is. When we have parent company and subsidiary company, or parent company and more subsidiary company. So they now consolidate their financial statements into one. So that is what they are presenting to us now. They are presenting the consolidated, that is the group financial statement of Octopus PLC. So we have the revenue, we have cost of sales, we have gross profit, we have distribution. From the explanation I gave last week, which type of analysis is this?
Time series analysis.
Thank you. This is time series analysis. We are comparing two what's it called together? 2 years. So thank you for that. So we have finance cost, we have profit before tax, we have tax expense, we have profit for the year before spillage cost, profit for the year before what? Before spillage cost. Then we have cost associated with Ogoni oil spill. Then we have profit for the year. Then we have Octopus Petroleum Group consolidated statement of financial position as at 31st December. So we have 2020 again, we have 2019. We have assets, we have current assets, we have equity, we have non-current assets, non-current liability. So let me say something about this. When one of our colleagues was solving one of the questions I gave last class, she got confused as touching the figure to use for capital employed. The figure to use for capital employed. Maybe in that question, maybe it was not stated like this. Please, when you are asked to calculate capital employed, you all know that asset, just use the accounting equation. Asset equals equity plus liability. Then, if you are looking for equity, capital employed is like your equity, is your share, ordinary share capital plus your reserve. So if you are looking for equity, that means you are going to say that asset minus liability. If you look at this financial statement, that the statement of financial position, we have our total assets to be 17,855. Let us say that this equity and liability, they did not separate it. Let us say they separated it here. We have a row for equity, then they put ordinary share, they put retained earning, and then they move to non-current liability. They move to current liability. Let's say the examiner actually looked everything together. They just say equity and liability, and they did not separate it. You should be able to factorize element of capital employed from that equity and liability. And how will you do that? You already know your total assets, then subtract your liability from your total asset. You will get your equity. You will see that if we add equity plus this total liability, we are going to arrive at the total asset. And that's when you say that my account is balanced. For skill students, you will be doing consolidated, you will be doing GPFS, General Purpose Financial Statement, where we'll be doing statement of profit or loss, statement of comprehensive income, statement of cash flow, etc. And then in that statement of financial position, we will say our account balance when our total asset is the same thing as total equity plus liability. So please let us take note of this. Whenever you come across a question and they did not separate between the current asset, the non-current asset, even your equity, and you want to get your capital employed, just try to look for the total liability, then subtract it from the total asset. You should be able to get your capital employed. But don't forget, if you are calculating, is it not gearing ratio now? That we say that long-term debt, that is long-term liability, that's your long-term debt. The debt that you cannot repay within a short period of time, that is your long-term debt. So the formula for that is long-term debt all over ordinary share capital plus retained earning, which is your capital employed, plus your long-term debt. You are going to add that long-term debt to it again. Please let us take note of this trick. Let us take note of it. If you are calculating for gearing ratio, in which I've stated the formula before, just take note that you are going to add the long-term debt back to the but in a situation whereby you are only looking for your capital employed, it will just be your total asset, subtract your current your liabilities, your total liabilities. You will get your what? You will get your equity. And that is what we call capital employed. All right, so let us move. We have additional information. Are we still together?
Yes.
All right, thank you. Let me check other people as well. Are we together, Miss Fins?
Yes, we are together.
All right. Mr. Ezekiel, please, let's be together, please. All right, so additional information. The 3,700 million.
Hello.
The 3,700 million provision for Ogoni oil spill is an estimated cost net.
Hello, sir.
Yes, sir.
Please, sir, which year is this?
This is 2023, November 2023.
SBR, right? November
Yes,
2023.
sir. Yes, sir. So the 3,700 million provision for Ogoni oil spill is an estimated cost net relevant tax. They are telling you that you see this 37, they have already net the tax. They have already removed the tax from it. So you are not expected to tax it again. So if you come to this side, so at times, even in financial reporting, they will give you this kind of information. So they may even ask you to prepare adjusted statement of financial position or adjusted statement of profit or loss account. They may ask you. You are just going to, okay, now let us say that I want us to be together, please, let us be together. Let us say that this 3,400, this 3,700,000 that is here, let us say it is not here. Let us say it is here before tax. It is somewhere here. That means they will have taxed it, whereas they're supposed not to tax it, because we have been told that 3,700,000, it is what? It is net of tax. They have already subtracted tax from it. That is the reason we are not bringing it here. There are some questions like that they will not have computed the adjusted statement of profit or loss account for you. They will ask you to compute it yourself. You will now use that adjusted statement of profit or loss account to now calculate your ratio. You should know that if you have actually calculated wrong adjusted statement of profit or loss account, there will be problem with the ratio you have calculated, and there will be problem with your analysis. And that is why many people miss mark. So you need to pay attention to all this information. Don't just say that, yes, there are some times whereby the information they will have given you is just to confuse you. There is no correlation between the information and the solution. But there are some times whereby those information, they are crucial. So you don't just ignore them. You need to read and understand, and you need to read and digest and understand those information. So we have treated this one like this. Roman figure 2. Calculating the financial cost of the oil spill in Ogoni land had been slightly problematic for Octopus Petroleum Group in many ways. However, 530 million has been expended by year end. The future cost of clean-up and compensation have not yet been identified or determined. Roman figure 3. However, one of such uncertain costs is fine, payable to federal government of Nigeria in respect of the incident. The appropriate arms of the NNPCL and the federal government are still investigating the incident and how Octopus Petroleum responded to the problem. Fines have been levied in respect of past incidents, and some are in excess of 2,500,000. So this one is also talking about when we were reading the other time, we were told that there was a oil spillage which has affected the agriculture and the well-being of that particular environment. So as a result of that, now they want to find them, but investigation is still ongoing. So let us move to number 4. Octopus Petroleum Group has vertically integrated in the second half of year 2020 by acquiring and rebranding a large number of petrol stations across the country. You can see now. Now, what is the implication of this Roman figure 5 additional information on our analysis, or even on the company statement of account itself? So if they have actually acquired more company and they have rebranded large number of petrol stations, that means it will have affected their profits. If before they have always been having 2 million as profit, now that they now have some petrol stations, they have diversified. They have acquired some petrol stations. They have rebranded some. That means their profit might have increased. So we must take note of that. If you notice that in your analysis now, their profit margin jump up, you should know what is responsible for that increase in profit margin. So you should be able to analyze it in your analysis, in your profitability analysis, that the company's profit actually increased due to the fact that they have acquired and rebranded some more filling stations, which will have generated profit for them in return. So take note of that. Octopus petrol oil reserves are at record high level at the end of the 2020 financial year. You see what I was saying now? That Roman figure 4 told us that they have acquired and they have rebranded large number of petrol stations, and as a result, their reserve has now jumped up, has increased. So what is the meaning of reserve? When the company make profit, for those of us that we are not coming from accounting background, when the company make profit, let's say they make 2 million. Out of that 2 million, the company may have the policy that, okay, out of this 2 million, they are going to plug back, or we are going to reserve 1 million. While we distribute 1 million as dividend, or we share it to the shareholder, we are going to refund 1 million. Don't forget dividend per share. We calculated the last class. Don't forget earning per share. We calculated it last time. Dividend cover, earning cover. Hey, go and revisit those ones. All right. So we move to Roman figure 5 or 6 rather. Also, the price of oil has increased by approximately 5% during the 2020 financial year. That is going to give them more profit as well. They have increased the price. Definitely, they will get more profit. In common with many oil companies, Octopus Petroleum Group value inventory are on a last in, first out basis. The auditor of Octopus Petroleum Group exceptionally allowed this treatment, although it contravened the accounting standard IS2. So this is another problem now. We all know that the accounting standard IS2 says that inventory should be measured. Okay, the measurement of inventory should measure at lower of cost and neutralizable value. It now states that the acceptable inventory measurement is FIFO, first in, first out, or weighted average. Last in, first out is not acceptable by the standard. But this company now, they make use of last in, first out. That means the goods that they purchase last is the one they will first of all sell out. So who can tell me the implication of this? What is the implication when the last good we bought was the first one we actually sold out? What will be the implication? Let us listen together, please. What will be the implication?
I feel like when the first good bought is being sold out first, number one, the ones in store, the ability, like the expiring date, some might have expired, and also the prices, price changes over time. So the ones that are in store for long, the price range might also
This network is not really stable. Our network is not stable. Okay, thank you so much, sister. Thank you for that wonderful point. Yes, when the goods we purchased last is the one we are actually selling out first. What happened to the goods we first of all purchased before we purchase those goods? Maybe you don't get it. You are selling bread. You purchased some bread last year. Those bread are still in your store. You now purchase another one this year. You now decide to sell the one you purchased this year first. That means the bread you purchased last year will still be in your what? Will still be in your store. What of if it has expired? It can result in loss. So there are a lot of issues around that. So thank you for that. So we have Octopus Petroleum Group maintain its dividend payment at 265 million for year 2020 and 2019. So they are still paying their dividend.
At 625 million.
Yes, thank you. 625 million for year 2020 and 2019. So Roman figure 9. It is the global practice for investors in the oil and gas sector to evaluate investment using the volume category ratio. So they say that the practice of investors in oil and gas sector is for them to what? To evaluate their investment using this ratio. So they gave us return on capital employed. They now told us, or they tells us that capital employed is equity plus borrowing. Equity plus borrowing. So we have return on equity. We have total profit percentage. Gross profit percentage. We have operating profit percentage. We have liquidity. We have current ratio. We have asset test ratio. We have use of resources, financial position, that is efficiency ratio. We have investment turnover, asset turnover, we have interest cover, we have gearing. Require 1 or require A. Analyze the performance of Octopus Petroleum Group over the 2-year period. Your analysis should also consider the group ability to finance the cost of the oil spill in the Ogoni land in the coming years. B. Annual reports of the group also contain separate financial statements of the parents, Octopus PLC. Some companies also include social and environmental reports as part of their financial statements required. You see now, explain what is better to use, explain why it is better to use the consolidated financial statement for financial analysis rather than those of the parent separate financial statements. So they said we should explain why is it that when we are analyzing the group financial statements, we use group accounts, like consolidated financial statement. Why can't we just use that of parents? Can someone tell me this? Can someone tell me the answer? Just tell me the answer. Why? We are dealing with the group. Why can't we use the one for the parent alone? Why must we use consolidated financial statements for our analysis? Is anybody here? Are we still here?
Yes.
All right. Can anybody try?
Okay. I feel like why they are using the consolidated group accounts is because if they consider only the parent company, they will have to pick in each of the companies one after the other. But bringing them together as a group company, easily the accounts can be analyzed.
Yes. Thank you. Thank you for that. So is there still anybody I want to add? See now that ICAN exam is cheap. So that she has made a point. If we use parent company financial statement alone, our analysis will not show the true picture of the group. We call it group. So if it is parent company is just one, and parents may have many subsidiaries. So let's say this subsidiary A made a profit of 5 million. Parent company made a profit of 2 million. Subsidiary A make a profit of 5 million. Subsidiary B made a profit of 10 million. If we are only using parent company financial statement, we will say the profit is 5 million, 2 million rather. But if you are making a consolidated, that means the profit will be like 17 million. So parent company's financial statement alone cannot show the true picture of the group. But group consolidated financial statement show the true picture of the group entirely. Thank you. So enumerate, that is from Article 2. Enumerate the possible content of an environmental report included in an annual report of a company. You see, that is another beauty of you coming to class. You see, this question now is in another chapter. This question about sustainability reporting, etc., is another chapter, but we are going to see how we can cover it together. So, one thing I want us to pay, you see now that requirement A, they did not tell you the ratio to calculate. They did not say that calculate this, calculate that. So, who can now tell me now what are the ratios we expected to calculate based on the information we have read so far? What are the ratios we expected to calculate?
Profitability ratio.
Thank you. Thank you. That is one.
And liquidity ratio.
Two. Thank you. Which other one? Even if you look at these statements, if you look at the statements here, they have already told you that it is the global practice for investors. Roman figure 9. It is the global practice for investors in the oil and gas sector to evaluate investments using the following categories of ratio. So they are expecting you to calculate profitability. Under the profitability, they are expecting you to calculate return on capital employed, ROCE. They are expecting you to calculate return on equity. They are expecting you to calculate gross profit percentage. They are expecting you to calculate operating profits. Then you move to liquidity. Don't calculate more than these four that they are stated here. Because calculate more than the four is, yes, it's good, but you may not have the time. You may not have the time. So just move to liquidity. So they are expecting to calculate current ratio, which is working capital. They are expecting to calculate asset test ratio. Then you leave that one. They are expecting to move to what? Move to financial position. use of resources, financial position. There's way to calculate efficiency ratio and what and gearing ratio here. So you calculate your inventory turnover, you calculate asset turnover, you calculate interest cover, you calculate gearing ratio. So please, all those ratios, they are very, very important. They are key ratios. They are key ratios. So the only ratio we are not asked to calculate here is the ratio that is of importance to the investor, investment ratio. All these any per share, dividend yield, dividend cover, etc. We are not asked to calculate that. So you don't need to calculate it here. So after you have calculated it, you do your what? You analyze it, then you respond to requirement B. So let us move. I want us to participate in this solving. The reason why I'm actually bringing a ready-made solution is because we are having an online class. If it is offline class, I would have loved that we are writing. But if I want to be writing for you in this class now, it is going to take more time. 2 hours, 3 hours, 4 hours, we will still be on one question. So that's the reason I'm bringing a tailor-made solution. But you actually do well better than if you actually do well if you can actually start writing this thing down. I can be giving you time, then you write it down. Have a note, write it down. Don't just say, I've seen it, I will go through the solution. Write it down, please. I know what I'm saying. As you are writing it down, those formulas they will be entering into your head, even without memorizing them, as you are writing it down. But if you say, I already have it ready-made, tailor-made, I will just glance through it. My eyes is magnetic. No, don't do it like that. Don't do it like that, please. All right, so let us go to the solution to this. Are we together?
Yes.
All right. So now, the first what's it called? We asked to calculate is the profitability. After the profitability, they asked us to calculate return on capital employed. Who can tell me the formula for return on capital employed?
The formula for return on capital employed is profit before tax over capital employed times 100.
Capital employed. All right. So now let us come to our question. So what you are going to do for me, I believe you have your notes before you now. Your note is actually on your table now. I want to believe that. So create like 4 column. One for the ratio you want to calculate. You want to calculate profitability now. You know what column means now? Something like this. This one is 3 column now, but I want you to create like 4. Okay, let's say this side, this side, this side, this side. Now before. So this place will be for the ratio you want to calculate. Profitability, you want to calculate ROCE now. She has given us the formula for ROCE to be profit before tax all over capital employed. So you now write 2020, let's say 2019 or 2020. Just arrange the year the way you want it. Okay, yeah, let us make it 2020 and then 2019. Are we together now? So you have already written the formula profit before tax all over capital employed. So let us come to our question. What is our profit before tax? What is our profit before tax? What is our profit before tax?
Our profit before tax. Yes.
Okay.
It's before tax for 2020 is 3,195,000. Why for 2019?
Okay.
Yes. Why for 2019 is 2,390,000.
All right. Thank you. So now, if you notice, the formula for capital employed is profit before interest and tax. Are you getting me? Profit before interest and tax. And yes, the answer you you actually gave to us is this, which is correct. This is profit before tax. But there is an interest element that has been subtracted from this profit before they arrive at this. So we need profit before interest and tax. What are you now going to do is that you will now bring that 3,195,000 profit before tax. Sorry, please. Yes, profit before interest and tax. You will now bring that 3 million, that 3,195,000 plus the finance cost. Your finance cost is the interest element. We say profit before interest and tax. We have profit before tax to be our 3,195,000. We now say plus what is our interest element, which we call finance cost. Finance cost is your interest. Finance cost. Are we still together?
We are together.
Yes. So 3,195,000 plus 210. You will now say divided by what is your capital employed. Your capital employed, as I've told you the other time, is your what? Your ordinary share capital plus reserve. If you have retained any also, you will add it. But if you don't have retained any, okay, here now you can see as we have here, they said equity, ordinary share capital, retained any. If you have reserve, reserve also is part of the equity. And if you don't want to use this, just say your total assets. Our total asset happens to be 17,855,000. 17,855,000 minus. Don't forget the account formula that says our asset equal to liability or equity plus liability. Now we want to know our equity. So if we make equity our subject of the formula, we will now have what? Asset minus liability. So what is our asset? Our total asset is 17,855,000 minus what is our total liability? So your total liability is your non-current liability plus your current liability. Non-current liability is actually 5,260. Then our what? Our current liability is how much? For 2020 is how much?
Our current liability for 2020, right?
Yes, ma'am.
Current liability for 2020 is 4,760,000.
So add that 4,760,000 plus 5,260, then subtract it from your total asset. You will see that you are going to get this. You are going to get this as your what? As your capital employed. So this is the figure we are picking as our capital employed. I believe we all understood it.
Yes.
Okay, thank you. So that is all right.
I also believe our equity is total assets minus liability, right?
Yes, sir.
And then
if they don't, this particular one is self-explanatory. I'm just trying to break it down. What if they don't give it to us straight away? We can see it here.
In the question,
Okay.
profitability has to do with the kind of they said like in question, they said our capital employed is equity plus borrowings.
Okay. No, they said what they have been using. Sorry, please wait. What they said industrial I'm trying to okay. They said return on capital employed. It is global practice for investors in the oil and gas sector to evaluate investment using the following category. So they now said return on capital employed is equal to equity plus borrowings. Equity plus borrowings. So if we want to go with that, right? If you want to go with that, we'll have said that equity plus the borrowing. But we are still going to use that. Are you getting me? We are
Okay.
going to use that, but it will not be when you are calculating for this losing. It will be when we are calculating for
Okay.
what's it called? Gearing ratio. Are you getting me? So
Okay.
this one, just use the formula that we know that is for sure. As you can see, the solution as well. What is being made use of here is the equity. Is this okay? Thank you for that. I think I've seen what you are trying to say. So normal is supposed to be like this, but because of the fact that they said, sorry for that, they said equity plus borrowing, we should add the borrowing to it. But in practice, in normal other practice, we don't used to do it like that until when we are calculating for gearing ratio. But because they said it here, let us leave it like that. Because they said it is the what? It is equity plus borrowing for this particular sector. For this particular sector, please take note. Because we are working on oil and gas. For this particular sector, we calculate it like this. So thank you for that. Thank you. So now, if you check our solution, you will see that we have done that here. All right. We have done that here. So have you done with your calculation now?
Not yet, oh. Not yet, oh.
So borrowing, as you can see, borrowing here. Borrowing is what? 2,090,000. So quickly calculate it. Just add it. Your what's it called? Your equity will now be 7,835,000 plus the borrowing, which is 2,090. So let us calculate like that. So give me the answer. What do you get? Let me check. Maybe it is correct with what I have here. For 2020, what is your percentage?
A minute, please. Let me quickly do the calculation. 3195 plus 2103 something 5293 7835 plus 2090. %.
53?
Percent.
Is it 53 or 33 point something?
Maybe I've
Check it
done
again.
rubbish. Oh.
Check it again. Check it
What do you
again.
say?
Check it again.
Okay.
Your
All
what's
right,
it
I'm
called?
coming.
Your profit before interest and tax is 3,195 plus 210, that is the interest, divided by 7,835 plus 2,090.
3195 plus 210. That's where I did rubbish.
Okay, just correct yourself like that. That's the reason. That's one of the reasons why it is good to write as you are being taught.
%34.
34%. So calculate for 2019
Yeah.
now. Yes, I hear you. Calculate for 2019. I believe
Okay.
all of us, we are still in the class.
Interesting.
All right.
We are still calculating.
Okay, that's good. So 2019, calculate for 2019.
Okay. 2390 plus 190 over bracket before 50 9605 plus 2380.
Okay, so for this work now, we both agree that our capital employed is the 50 plus borrowing, right? Does anybody hear me?
Yes, that's what he said. For the sake of this one.
Okay, thank you.
For 2019, I got 21%. 21.5%. That's 22%.
Okay, 2020, 34%,
What did you say?
34.1 basically. 2020,
Yes,
34.1%.
yes.
Okay.
I don't think Mr. is interested on this call.
I think let me finish solving so that we can move to the next one. I think before he comes back, we'll get somewhere.
I didn't hear you.
I said, I think we need to move further. We need to solve the next one. I think before he comes back, we have done something.
Okay.
The second one is 21.5%.
Yes. Let's do return on equity if we can actually try return on equity.
So that's
Return on equity.
okay. return on equity, that's earnings after tax.
After tax minus non-controlling interest minus
Minus non-controlling
preference.
interest,
Yes,
minus preference dividend too, divided by
equity minus
equity
non-controlling
minus
interest.
non-controlling interest.
Yes, yes. I don't think there is non-controlling interest and preference dividend now. Is there anything like
Yes,
that?
it's not there. There's no preference if there are non-controlling interest, non-controlling interest.
Okay,
It's just profit after tax.
okay, thank you.
For 2020, 32.6%.
That's what I got as well. Why for 2019? 19.5.
2019 is 19.5.
Yes.
Okay, I think we are on the right page. Let's move on to the next one. What's the next one?
Gross profit
Gross profit percentage. That's gross profit over sales times 100.
yes. Gross profit over
All right. We don't know. I can see your group work. I don't know Nigeria factor actually. So that's
So you
good.
are still on the, with this.
I was hearing, I don't know, my system just, the telegram just went off and I noticed that I could not, I was talking, but you guys cannot hear me, but I was hearing you. So that's
It's
good.
not even showing you that, it's not showing you that you are part of the group.
That's good. So where are you guys now?
Gross profit
number 3.
percentage.
Gross profit.
So quickly calculate that also. Quickly calculate that. So gross profit. What is your answer for return on equity?
For 2020, 32.6%.
Okay.
Oh, we did
For
not do
2019.
rubbish.
For 2019 is
For
what?
19.5.
19.5. That's good. That's good.
Don't worry, we didn't do rubbish. We didn't do rubbish.
You know the rubbish. All right. So calculate for gross profit.
For 2020, 21.7%.
Okay.
2019.
Wait, oh, let me calculate. Oh, wait, oh.
Okay.
So as we are calculating, I want to chip in something. You see that return on
Okay.
equity? That return on equity, there are two ways or two return on equity we are going to calculate. You know, we have profit after tax before the spillage,
Yes.
and we have profit
And
after the spillage. So you can calculate
yes.
for before the spillage and then you calculate for after the spillage. Do you
Okay.
get?
But the
So
one
you have
that there
already
is loss, are you going to use the loss?
yes, it is lost. Yes, it is lost. It is lost. So you
We will
calculate
use
it
the
as
loss
well.
as well.
Yes, you just use the loss like that. Just use the loss like
All
that.
right. Okay,
All right.
thank you.
So because of our
Okay,
time,
so you are saying that in case of the question, we calculate for before and then we calculate for after.
yes, you know that this particular sector we are dealing with, they have a problem, a spoilage problem, and then they later incur the spoilage cost. So they have a profit, they have two profit after tax. They have a profit after tax before the spillage cost. And after they have deducted, okay, they now said the cost of the spillage cost is 3,700,000. So if it's subtract that 3,700,000 from their what? From their profit for the year, which is profit after tax, they'll be having loss, right? So we're supposed to calculate for profit for the year before the spillage cost. You know, the reason why we are not this spillage cost now, assuming it is not net of tax, we will have brought it in before we actually charge our tax. But we were told that it is net of tax. It is net of tax. That is the reason we bring it after we are charged the tax. So just calculate before the spillage and calculate after the spillage. Then just leave it like that. Do you get?
Okay, thank you.
All right. So have you done with the gross profit now?
Yes.
So please, operating, go and calculate that one yourself. Liquidity, you can calculate it. Is what you can calculate. What is the formula for liquidity ratio? The current ratio.
Current ratio over current asset over current liability.
So just check your question. What is your current asset? What is your current liability? And don't forget that industrial average is 2.2:1. So you calculate that one as well. What is the other thing they asked us to calculate? They said we should calculate asset test ratio. What is the formula for asset test ratio?
Okay, I think it's current asset minus current liability.
Current
Current
asset
asset
minus
Asset minus
over
current liability.
it is current asset minus inventory all over current liability. Current asset minus inventory all over current liability. So that one also is gone. So which other one did they ask us to calculate?
use of resources or financial position.
So what is industry? What is inventory turnover? What's the formula for inventory turnover?
Cost of sales over average inventory.
Thank you. And I told us that average inventory, if they give you opening and closing, you are going to add opening and closing together and divide it by 2. But in this situation, I don't think they give us opening and closing. Let us check.
Oh, cool. They gave us inventory under current assets.
That is closing. That is closing inventory. They did not give us opening inventory, right? So you just use the closing inventory figure like that. So you get the systematic logic now. You get the logic now.
Yeah.
So that is how to calculate everything. And as you can see now, you see borrowing, the G&A ratio, the interest cover. Please, after the class, please, I want you to go and calculate this thing yourself again. I will send the copy of this one. I will send it, but sit down and calculate it yourself. Please, sit down. I know the reason I'm starting from this angle. And by the grace of God, I know that we will all succeed. So let us go to analysis. This is the analysis now. Profitability. Don't forget the way we normally do it. You are going to write the heading. What are you writing on? We are writing on profitability. As a matter of fact, even if you have the time, you can write profitability, and then after you have written profitability, then now bring return on capital employed and tell them what return on capital employed is. Refer to the first class, tell them what it is, and tell them what you have seen. Octopus Petroleum Group underlying profit performance in the year is what? Is strong and is reflected in an increase in the year profits by 680,000 million for the year 2019. If you check now, you will see that even from this place, from this analysis we have here, their profits increase. Their profits increase. And they even told us when we were reading this side that their profit actually increased. Yes, they told us that they ventured into some acquisition and rebranding, and as a result, their profit actually got increased. So you can tell them the reason why their profit got increased as you are doing your what? As you are doing your analysis and the interpretation. So the strong position of profit performance of Octopus is also reflected in the return on capital employed, which increased from this to this. It is not necessary that you structure your report like this. Don't forget what I said. If I want to do this inside the examination and I have the time, I will be picking this ratio one after the other. I will say return on capital employed. It shows the relationship between the what? Between the profit before interest and tax and then the Octopus PLC actually increased from so percentage, from 19.5% to what? To sorry, not 19.5, from 21.53% to 34.31% in 2019 and 2020 respectively. This increment is as a result of the acquisition. So I will add things to it. Then after then, you can move to return on asset. You will tell them their return on asset is what? It shows is impressive, or it also increased from so percentage to so percentage. But don't forget, first of all, tell them the meaning of return on equity. If you have the time, it's actually good if you have the time so that you get your full mark. So we have for the return on capital, we have the decline. If you notice, after the spillage cost, after we calculate our return on capital using the spillage cost profit, after the spillage cost profit, profit after tax, after the spillage cost, you could see that their profits decline. It actually declined from what? It declined. The decline noted on the return on equity from 19.7 in year 2019 to negative 14.61 in 2020 was due to huge provision for costs associated with what? Oil spillage. So we tell them the reason why there was a decline. So the percentage we got here after this spoilage cost, yes, this one, we know that it's a negative. We know that it's a negative as at 2020. So, and what caused that? In 2019, they did not pay spoilage cost, so they did not experience that. But in 2020, they paid. They were charged 3.7 million, and that actually reduced their profit. So we were able to establish that fact. We were able to establish that fact. The vertical integration during the year, which established with establishment of petrol station, we are trying to tell them the reason why their revenue jump up now. Also contributed to growth in revenue by over 10% from what? From 19.345 million to 21.290 million. So I've also said this the other time. I would have even said it when I started my return on capital gross profit, because in gross profit we use gross profit over revenue. Their revenue has jumped up, and that has actually influenced the percentage we have gotten. So this is how you structure your report. Then we move to liquidity. The liquidity position of the company appeared to be stable with current ratio of 2:1 for year 2019 and 2020. But there has been negative shift in liquidity position when the acid test is considered. This could be as a result of decline in cash position of Octopus Petroleum as a result of payments made in respect of oil spill, while the inventory level are increasing. There is also the future possibility that the cash position of company will decline further when they might pay more fine and penalty in respect of oil spill in future. You remember that in that additional information, they were told that they are still investigating. So after they are done with their investigation, there is a tendency that they will be charged or they will be asked to pay more fine for the whole oil spillage. So we actually try to inculcate that in here also. So what is use of resources of our financial position? We are trying to analyze the efficiency ratio now. The inventory turnover has reduced significantly, which has contributed to the stability of current ratio. The high level of oil reserve will be a major reason behind this and align with higher oil price, which will be reflected in much inventory because of the use of LIFO. You see, as he said the other time, now they now have much inventory, more inventory in their custody as a result of embracing last in first out. And even those inventory, we don't know, something might have happened to them because the last inventory, the last inventory they bought was the one they issued out. What of those one they have bought initially? They will still be there. They will still be there. The additional reserve necessary to service its group of petrol station will also be contributing to factors here. All right. Okay, we have the profit percentage of company is good enough with increasing margin, improved revenue, and adequate provision made for possible cost of oil spillage. Also, the group has been able to maintain the same level of dividend payment for the year 2019 and 2020, despite the huge provision made for cost associated with oil spillage. Disaster will impact on the group financial performance and position for years to come, and the group will be considered to be fortunate in that its core business is so strong and that it has also built up its oil reserve at the year end. Although cash and cash equivalent of Octopus Petroleum have dwindled during the year end, are not adequate to cover known estimate of cash flow of the oil spill. However, the incentive levy oil reserve could normally be disposed of fairly quickly, and this could absorb any future liquidity that may arise in case of payment of fine or penalty for oil spill. Also, the gearing level of Octopus Petroleum is fairly low, hence they could still accommodate more borrowing to meet up future commitment. Conclusion: in light of the mitigating factor highlighted above, investors may still invest in Octopus Petroleum. So based on all the findings we have seen, we have analyzed their financial statement to see that they are still doing well, they can still pay the dividend, etc. We can still tell the investors to do what? To come and invest in this company. So we move to B1. What is the uses of consolidated financial statement for financial analysis? Why do we use consolidated financial statements? Using consolidated financial statements for financial analysis is better than using the separate financial statement of the parent companies because consolidated financial statements provide a more accurate and comprehensive picture of the financial health and performance of the entire group. You know, we said this the other time. That was what one of the things that Sister actually made mention of. It ensured that manipulation is avoided as all assets and liability are shown together. It shows the group as a single economic unit. It helps to determine the liquidity position of the entire organization. If you are calculating for the group, for the parent alone, you are only looking at the direction of the parent. You are only considering the parent alone. But when we are, that is the reason they call them group. So if you are saying that we are doing financial analysis for the group, the subsidiary figure should be included. All right. So we have number 6. Roman figure 6. So consolidated financial statement provides stakeholder with full information concerning the entire activities. So just note that if we are using separate or parent company's financial statement, we will be dealing with just an aspect of the group. That means we are not achieving our goals or our aims, because our aim is to actually evaluate the group as a whole. Therefore, we need to actually have the information of the group. And as we said the other time as well, if we say we should not be doing the analysis one after the other, we did for this parent, we did for this subsidiary, we do for this subsidiary, it's going to take longer time. So these are the things you can actually use your own discretion to answer, even if you have not read about it. But thank God that you have read about it now. So there are still a lot. So we have key environmental performance indicator. Key environmental performance indicator. We have financial information related to environmental cost. This is B now. We are still answering B2. This should be B2. Financial information relating to environmental costs, including the entity accounting policy, results of test of regulating authority. These are the information that must be included. Environmental impact of gas emission, details of any provision or contingent liability relating to environmental matters, the amount charged to income statement during the accounting period in respect of expenditure to prevent or rectify damage to the environment caused by the entity operation. By including an environmental report section in their report, companies can demonstrate their commitment towards sustainable development, transparency in environment, in environmental performance, and accountable corporate citizen. So we are done with the question like that. Is there any other questions?
Yes, I have questions.
All right.
What you were reading, the answer, the analysis you gave now, are you going to send the copy
Is
to
what?
us? Do you hear me? Hello?
Ma, I'm with you.
I said, are you going to send the copy to us?